For today's program, we will have two panel discussions moderated by Ms. Chong Van Nie and Mr. Vida Corgil, both co-heads, Infrastructure and Utilities at RAM Ratings.
Assalamu alaikum, distinguished panelists, ladies and gentlemen. A very good morning and welcome to RAM Insight series. Today's webinar will focus on two sectors that are critical to Malaysia's economic development. Over the last 3 decades, debt issuances for the power and transport sectors accounted to a sizable 345 billion ringgit. These investments come with its fair share of challenges and issues. Today's webinar will seek to address some of ongoing investors' concerns and issues on the ground. That said, there are ample opportunities for the debt capital market stakeholders, including RAM, to continue supporting the highway restructurings and refinancing, as well as funding for renewable energy to drive Malaysia's green agenda. With the presence of our distinguished panelists, I am confident that the two sessions will provide invaluable insights for us. Do make the most of these sessions, and if you have further queries or would like to engage us directly, we are very happy to accommodate. With that, I would like to record my appreciation to the panelists and everyone for your presence this morning and for your continued support. Thank you. Over to you, Hasli.
Thank you, Encik Zabah. Without further ado, please allow me to invite our moderator for session 1, Ms. Chong Van Nie, RAM's co-head of Infrastructure and Utilities, to introduce our 3 distinguished panelists. Please submit questions for session 1 anytime through the Q&A box. Over to you, Van Nie.
Good morning, everyone. Thank you for dialing in and welcome to session 1 of today's webinar. Now, my name is Van Nie and I will be your moderator for today's panel discussion. And with me here today at RAM's office are 3 esteemed panelists, and I'm very excited to introduce them to you. I have Encik Halim here, CEO of Sterling Insurance Brokers. And then I have Mr. Wira, who is the Principal and Managing Consultant from Advision. And last but not least, Mr. Eric Ho, the Head of Project Advisory from Maybank. Now, welcome, gentlemen. Thank you very much for joining us today. Now, given your experience in the field, I'm sure the audience is looking forward to a very robust discussion about today's topic, that is greening the power sector with bond funding. Now, we've just heard also from our CEO earlier that the Malaysian bond market has a very long history of providing the necessary funding to support the expansion of our power sector, and especially in the sub-segment of conventional fossil fuel power plants. And suffice to say, today, Malaysia is currently blessed with a relatively adequate and reliable electricity supply. Now, as we move into the future, can this market still support our efforts to build more renewable energy as we transition into a net zero nation by 2050? So before we start the discussion, I would first like to invite the audience to take a quick poll. Hasli, appreciate it if you could pull out the poll question. Okay, it looks like a mixed bag that we have here in today's audience, but I would say that it looks like everyone is largely skewed towards project performance and technology risk. And the next one would be commitment of project stakeholders. So hopefully today's panel session, we would be able to address some of these key concerns that we have here. So let's start the ball rolling right now. To set the scene, I think I was talking about energy transition earlier. And as part of that acceleration plan, recent news that has came about include the upsizing of the corporate green power program, as well as the recent lift of the renewable energy export ban. Now, Halim, could you please help us set the scene by sharing with us your views on the opportunities and outlook for the power sector, given the policy direction? Over to you.
Thank you, Van Nie. And again, thank you very much for all the other panelists to be here with me as well, to share perhaps a very interesting, if not objective conversation. For me, I think even as of this morning, the economic minister has announced that there's going to be 25 billion worth of national energy transition projects. That in itself is a pointer towards perhaps engaging every sector of the industry to come together, perhaps to promote a better, cleaner energy for us and a pathway to greater investments and moving Malaysia towards corporate Malaysia in a more targeted sense. But let's be real. In all this, on the long-term strategy pathway for transition, I think it has also been mentioned. We also know quite clearly that in most cases, there are the micros and the macro parts of it. So among those, which I will not go through all, but among those are like end-use sector electrification, low-hanging, rapid expansion of renewable generation, low-hanging, but also execution risk issues, which we got to look at, energy efficiency solutions. I think this is real. And that's where, if you look at an organization, you're talking about building your balance sheet and making your net profits from efficiencies, not just growing the business. Emerging technologies such as clean hydrogen and batteries. It is real. We have to do this. Otherwise, our solar plants and all that may not necessarily just be the intention that we need or the focus that we need in the future, because we need it to be baseload. And perhaps sectorial expansion and affiliation with international partners or cross-border activities and all that are also real. But take this down to the reality of microeconomics. I think we got to look at the issues. When we transition, we must also consider the age of our installed capacity and new technologies out there. The new technologies, whilst it's moving very quickly, does not come without any risk. Hence, we got to look at technology risk, which in the poll just now, there are some who's concerned about it, but I think it's an important feature. Current baseload plants are mainly our gas and coal-fired plants, thermal energy. Now, with many of them, which will be retired, simply because of the PPA age, as well as the age of the plants. What do we do next? As the nation, as well as globally, we need to go green. No real RE baseload replacement technologies out there. We've got solar, we've got biomass, we've got most of the other renewable energy. Apart from hydro, I don't think we've got a baseload solution. So solar may not be if battery is not in the equation. Battery carries its own difficulties as well. And of course, we cannot just depend on a certain energy mix. Therefore, until energy storage is available and reliability as well, reliable and cheaply, we will have a dependence on thermal energy. And hydro, if there are enough potential sites, I'm not just suggesting this, I think it is real. In the case of hydro, the real huge potential perhaps is in East Malaysia, in Sarawak. That's what we got to look at. So let me switch you to opportunities. Like all businessmen, we look at issues, we also look at opportunities. Consider using gas as base load and continue, perhaps import power from Sarawak. I'm not sure whether the government would want to go down this route, but it will promote not only corporate Malaysia, but Malaysia borderless in that sense. Because today, even if I go to Kuching or I go to KK, I still have got to use my IC. I'm a second-class citizen. Why do we have to do this? We've got to be one Malaysia in that sense. So where resources are, we got to build them. Number two, perhaps, modernize and extend life of all hydro assets in the peninsula. We've got hydro assets in the peninsula, badly run, not necessarily economically viable for some, but we still have got the ability to maybe modernize it a bit more un-rocket science in that sense. Then perhaps we continue solar power development, but smartly. We've not been doing it very smartly because we have exposed real estate into jeopardy by power developers running after real estates and all this. Perhaps because of our grid and grid stability requirement, our injection points are all over the place, and this needs careful study in terms of our security structure for our transmission lines as well as our grid facility. Beyond that, electrification. I think hydrogen, for example, Sarawak is already big in it. I know in the West, Petronas is heading into this direction, and perhaps many other organizations are considering it. These are somewhat close to rocket science. It needs a bit more attention to details. It needs a bit more requirement in terms of commercial valuation and evaluation to make it work. Remember, every drop of fuel that we use, as far as the fossil fuel is concerned, if we electrify it, we save subsidies because we've got serious subsidies on our fossil fuel. And perhaps lastly, beyond energy efficiency sector, which is also important and low-hanging, we should also look at the growth sector from a CO2 reduction standpoint. I think This is, ladies and gentlemen, among the most important precursor for ESG, because to me, ESG is all about moral compass and integrity. It is for our children and grandchildren to have a better world in process, people, and planet. Put aside profits for the reason for CSG, and I think ESG will play a bigger role. Stop enriching just individuals in the process, but make corporate Malaysia the reality for promotion of growth. I believe with that, my other panel members will share with you other interesting stories in this. Thank you, Vanny.
Thank you very much, Halim. What a colorful opening. And I hear many, many perspectives from hydro, solar, all the way, to hydrogen, as well as, ESG and CO2 reduction standpoints. Thank you very much. Now, I think right now I would like to turn to Vera here. I think in line with all that, Halim has just shared with us, the government is very ambitious. There is a recently revised RE target. We are now heading to have 70% renewables in our power capacity mix by 2050. And along with that, supposedly a Malaysian energy transition roadmap is to be announced very soon. Now, along with that, we have also heard whispers in the market. There is an anticipation for an introduction of guidelines for third-party access to a national grid. So, Vera, from a technical advisor's standpoint, can you share with us what are the most important policy as well as technical adjustments that would allow a successful implementation of a TPA framework in Malaysia?
Yeah, it's a good question. I think Halim has given a very good insight about what's happening in the energy transition sector. I think, as rightly mentioned by Halim, I think Malaysia target to achieve 40% renewable by 2030. If you look at the current generation mix in the grid, it is approximately 25%, which is in line with the target set by in the year 2021, right? So it means we are progressing towards achieving the target of 2070. So there are pros and cons in these concepts. One is the good policy is government announced to stop all the new built coal plants. That's a very good initiative they made. The next announcement is efficiency improvement in the existing plant, right? You cannot drastically make a big change in the existing plant. At least do some energy efficiency studies to ensure, so improve the carbon footprint, yeah, on that perspective. Then, of course, the large-scale solar development program, LSS program, is continuously announced by the government. It means they're giving more priority to the renewable energy mix into the grid, right? Of course, there are some technical adjustment needs to be performed to make these policy changes. The number one is renewable energy structure, tariff structure in the PPA needs further review, right? So we have got a very, straightforward tariff structure for gas to power, LNG to power, or conventional power scenarios. But renewable is pretty new, so we need to have some PPA needs further review. Then priority dispatch for renewable generation, of course, it's happening, right? We need to observe the energy as it is developed. For example, you cannot have continuity in the energy supply from renewable sources. It has got intermittent supply. Yeah? We need to streamline through a battery. It's an expensive solution. Its technology is yet to get mature, right? Then, of course, we ignore about carbon tax adjustments. We talk about improving the energy transition, improving the renewable energy mix. So it comes with the carbon tax adjustment. As long as the government gives you any carbon tax adjustments, so they will love to develop renewable energy plants, right? Then, of course, reliability and availability adjustment to the PPA. So critically, PPA looks at high availability and reliability of the plant, right? In renewable generation, it may or may not be possible. But if you take the runoff rate of hydro, you cannot expect high availability and reliability from the plant, right? Then the another important thing I want to touch is we talk about energy mix into the grid. So Malaysia has got strong solar and hydro potential. Sarawak has huge hydro potential. If you look at Indonesia, they got some offshore wind and solar. If you take Vietnam, they got heavily offshore. If you integrate the entire grid, Asian grid, single grid, it can maximize your green energy mix. That should be our ultimate aim. So country perspective, yes, we can achieve zero emission target by 2050 or 2070. But as a whole, as a Asian, we need to integrate the entire grid that will maximize the green energy potential, right? So that's my view. So by doing all this, so what's the impact to the market players, right? So of course, availability issues to the existing plant. Whenever you do the energy efficiency as a adjustment, we need to see what sort of availability loss we are going to incur, right? How is going to impact the PPA, right? Then of course, you cannot have the funding for energy efficiency studies. It has to come from the regular revenue stream. So we need to see how far it can be supported, right? If any new technology or anything comes in, the funding has to be accommodate that new technology proposition. So this is my overall view about achieving net energy transition 2070.
Okay, thank you very much, Veera. Thank you there. I think you have touched on some, I suppose, some fundamental issues. Very well pointed out. I think energy efficiency, of course, it is the frontier right now. A lot of projects perhaps will be going towards that direction. But ultimately, whatever that's being introduced in the market, regular revenue stream will be very important, which then brings me to the question of funding. I think from a banker's perspective, Eric, would you be able to share with us how you see the prospects really for renewable energy sukuk and bonds in Malaysia?
For renewable energy sukuk, I think really we'll continue to see very strong demand. The last few green SRI issuances, we have seen stronger than anticipated demand. I think in a sense, because of the focus on ESG, investors are going into green SRI sukuk, but it's really not a case where investors are investing in this sukuk purely from an ESG angle. I think they will still examine very carefully the underlying credit profile. They will want to make sure that the risks are properly passed and mitigated. Right. But all things being equal, if you have two projects with the same credit profile, we think the ESG linked one will gather stronger investor interest.
Right. Interesting. I suppose that is again back to the push for sustainability and also interest for lots of green, right? Okay, now I would like to move on perhaps to performance risk. Now, performance risk is a key driver for credit risk, I would say, simply because ultimately power projects, they are not short-term assets. They are long-term assets, largely supported by long-term funding. Now, Veera, if I may ask you this, from your perspective, what are the top risks facing power projects today? Now, as you know, the Malaysian market is still largely supported by conventional fossil fuel power plants. Perhaps you can, start from that perspective.
Yeah. So topmost risk we can see is, achieving reliability and availability targets set by PPA. That's the critical risks most of the plants are facing, right? So if you look at the conventional technology, almost mature, it's a very long history on the conventional technology. It's easy to achieve the availability and reliability. When you come back to the renewable energy source like runoff river of hydro, very difficult to achieve the reliability and availability. So that's the foremost risk I can say. The next is plant performance, the capacity and heat rate degradation risk. Yeah. So most of the PPA request some fixed amount of capacity and heat rate degradation. So it means conventional plant can easily achieve. When it comes to the biogas or some of the hydro, we need to really look at. Then the next one, solar generation profile, achieving solar generation profile in line with your, dispatch factor.
Right.
That's another critical risk. It means you need to streamline the generation profile utilizing the energy storage concept. Whether we can do that or not, we need to see. Then energy profile from mini hydro. We need to observe the energy as it is, right? So we cannot dictate, okay, this would be the limited availability or reliability in nature. Then of course, efficiency of the biogas plant. We talk about appreciating the biogas plants, but the efficiency of the biogas plant is very low. So if you compete in the tariff structure in the market, you cannot really compete. We need to find out a different tariff structure scheme. So these are the critical, key risks faced by most of the plants in the country.
Okay. Maybe if I can maybe ask for a bit more elaboration, because if we look at I think what's been happening in the last 2 years, building projects during MCO during the pandemic, it came with its own issues. Key construction risks. Yeah, and what can be done really to mitigate some of these risks?
Yeah, see, in last 2 years, because of this pandemic, the whole project is stopped. Most of the projects have been stopped. I can give you 2 projects example. One project in Bangladesh, of course, it's an ultra supercritical coal plant. It is delayed for 2 years. The reason being, they could not mobilize the personnel properly because of the COVID-19 impacts and so on. So still we are in the recovering stage. So it will take another couple of years. We are anticipating next 3 to 5 years, this will get streamlined. It means whatever projects are getting developed now, okay, it will get streamlined in next 3 to 5 years time. Still, you may face some project delays and manpower issues and talent mobilization issues. These are the critical risks, right? So that's my perception. Yeah.
Right. Okay. Okay. Thank you for that. Halim, do you have anything to add on this?
Yes.
Yeah.
Yes, because apart from the technical issues that Vera has raised, there are also insurance issues in all this. But taking Vera's standpoint, I think two other issues where in Malaysia, this is where I think regulatory framework and policies and reforms must come in. One of the top challenges that we see, simply because of the competitiveness of the tariff by the off-taker, plants may not necessarily be feasible. Sunken costs have gone in. Investors, perhaps project sponsors also have got difficulties in project execution with those issues. And to accelerate further, you've got increasing financial costs and significant need for contingency funds, which is required by the banks as well. So all that boils down to, from the insurance standpoint, it becomes far more complex in terms of assessing power projects involving intricate technical, commercial, and operational evaluation, both construction as well as operational risk. Especially during commercial and technical negotiation, it requires absolute, I would want to say this, in terms of risk management mindset and risk management framework. So if we fail to do this at the onset, the chances are you will then be faced with having to do what we call firefighting. When you don't plan, you plan to fail. And this we have seen in the insurance industry as one of the major risks in having to provide collaterals, commercial, reasonably priced premiums, simply because risk management is on the back burner. And that's real for the insurance industry. And if I bring it down to some of the top risks today, we've also got inclement weather. The weather swings, the climate change is something that's purely uncontrollable. Whilst we call it acts of God, but it gets promoted when we don't plan, when we ourselves do not foresee this as a risk and create this and shoot ourselves in our own, I would like to say the word backside, but in our own foot. And don't put this in the back burner. Regretfully, that's the challenge. And of course, for the insurance industry, we also worry when there's a great push for faster delivery of project and stretching the maintenance schedules. This is exactly what Vera says. Because of the pandemic, projects are pushed forward. But in pushing forward, we then push everything else to deliver it in time to make sure you're locked in for your operational phase, to ensure profitability. And the end of the day is to be able to pay back this gentleman called Eric. You don't pay his bank loan, he's going to foreclose on you. So with all these pressures, who takes the back seat? Owners and sponsors. Who takes the front seat? The insurers, because we've got to pay for this collateral damage. That's right. Hence, ladies and gentlemen, boys and girls, if you're listening out there, it is very important when you want to get into any project, your mindset must be about execution risk. That goes down to what we call risk management framework, as well as ESG, ladies and gentlemen, sustainability. My take, Bani.
Thank you very much, Halim. Now, I think drilling down into that, right, we'll be interested to hear, do you actually observe any trends when it comes to claim patterns really in the power sector? Is there like a certain repeated trend?
Thank you. Yes, there is. Most power claims under operational insurance program is to do with machinery breakdown and loss of profits. Machinery breakdown is also because, exactly like Rija says, today a lot of innovation are all done by the manufacturers. The project companies depend on the manufacturers for all this innovation, but at the time of negotiation, more often than not, we forget that some of this risk depends on the appetite of the developer and project sponsor. And that appetite, ladies and gentlemen, is premised upon knowledge of doing the business. So if you are perhaps fishmonger, a butler, you got no business in developing power unless you got the right guys on it, the right people in it, the right technology expertise, the right creative analysis that you need to do in order to make it work. And beyond that, Bani, I also see Some of these plants are in secluded areas. So because of the secluded areas, with the C19, with the economy going the way it is, and also the cost of living is being very expensive today, theft is becoming more real.
Right, right.
So we're starting to see this. And therefore, not just knowledge in developing the plants, maintaining the plants, but security is also an issue. So it goes back also to moral compass. And all these thieves perhaps are from within to some extent. So there are also issues of this nature that we got to deal with, which are questions of integrity. Can an insurer take all this risk? No, because we cannot cover mom and dad too. And I believe claims due to external causations are mostly weather related, and this can be seasonal. So the fact that it is seasonal, we will know, like in Malaysia, when the drought is going to come, when the floods is going to come. So I believe plant owners, project management companies must realize, take into account all this, because it will come. It's only a question of when. So if we don't do anything with it, we are still shooting ourselves in our own foot. And really the last ongoing concern is about risk mitigation and loss prevention. I think this requires tactical planning, not just planning, tactical planning. And this tactical planning must be done at the onset. So you get the people like Eric, you get people like Vera, you get people like Vani into the scheme of things right from the beginning. You cannot just trust somebody who you met on the street who's got all these ideas about project development. He will possibly run you into the river. My take.
Right. Thank you for that, Halim. I would like to stay on this topic if you don't mind. I'd just like to go back to Vera again. I think renewable energy obviously will be a key focus right now. Firstly, it's new to the market. Secondly, we are accelerating this sector. And thirdly, also, I would say in terms of familiarity, the market perhaps will be less familiar compared to, the traditional, conventional fossil fuel plants where the market has seen over the last 20, 30 years, right? Now, earlier on, you touched on hydro. You talked about, the reliability may not, be fully there compared to, say, a conventional fossil fuel plant. And then you've also touched on biogas being less efficient, perhaps because of technology constraints, and also solar. I'm just wondering if you could drill down and elaborate a bit more on that, and perhaps do you have like a ranking of risk? Which types of these projects do you see is more risky versus the other?
Great question.
Yeah, it's a very, very good question. But, unless you go to a detailed risk analogy, we cannot judge which plant is superior and which plant. So, of course, there are certain efficiency improvement is possible in the biogas plant. Right? So, while selecting the technology, with advanced technology, still you can achieve the, biogas plants to close to the.
Sorry, can I ask a question? Biogas plant, can you actually really scale up?
You see, there are some scaling up. There are some issues on the scaling up.
Okay.
The single biomass plant, you can go to 100 megawatt or 80 to 100 megawatt range.
So if a single buyer don't play ball, you can't do anything, right?
Exactly.
So it's reforms and policies.
Yeah, that's right. Yeah. So of course, see, there are some technological advancement is possible. That's a separate question you want.
Yes, that's right.
So I can touch on that. See, technological advancement in various technologies possible, right? So everyone talks about conventional energy gives more CO2 emission targets and so on, right? So now we are talking about hydrogen combustion into the gas to power units. Of course, we can inject hydrogen into the gas to power plants.
That's right.
But there are some complex scenarios, like we need to change the combustion hardware to inject the hydrogen into the system. When you inject the hydrogen, right, it has got high adiabatic flame temperature. Your NOx emission will be high. It means to suppress the NOx, you may have to have SCR into the.
So you've got
picture.
other sacrifices.
Other sacrifices. So when you fire the hydrogen, because of the adiabatic flame temperature is high, the maintenance regime is also shrinking. Suppose gas turbine plants has to go for certain maintenance regime. Because of the hydrogen introduction, your maintenance regime has to be shortened. It means additional
shorter maintenance regime.
Yes, correct. Okay. It means if the gas turbine will go for the major inspection once in 6 years, when it reaches to 100,000 hours. When you fire hydrogen, it has to be 1 hour is equivalent to 3 hours.
Okay.
It means
so you got to half it.
Yeah, half or 1/3.
Right? 1/3.
Yeah.
Oh,
so it means
OPEX
so
every 2 years.
Frequent maintenance.
Yeah, correct. Which means the OPEX cost will be higher.
Right. Okay.
So when it comes to the I talked about this one. Now existing boilers, all are coal-fired boilers or oil-fired boilers.
Right.
Now the current technology is available to fire ammonia
Okay.
Right? You can fire ammonia into the boilers. Yes, the technology is ready, but the main complication is when you fire ammonia, your NOx is drastically going to increase. It means definitely you need to have SCR. It's additional cost component. In cost component, efficiency will be low because of SCR is going to absorb more power into it, right?
Are there reference plans to all this?
Yeah, I think there are few plants in Japan.
Okay.
They currently, I think Mitsubishi has
Running ammonia.
no,
and firing
Kawasaki has
ammonia.
developed one plant, which is marine boiler firing 100% ammonia.
Wow.
Right.
Okay.
So means still they're emitting the gas out by proper correction. It is not in the sea emission. It's not a
Right.
Still they are making a lot of corrections. Right. Then when you come back to the renewable side, right?
Stop. What about environmental impact in situations of this nature?
No, environmental impact. Of course, technology is available to suppress the environment.
Okay.
The NOx emission is going to be higher, so that can be captured.
But you manage it.
Yeah, we can manage that. All environmental compliance, no issue. We can manage that. When it comes to the renewable technology, right? So now renewable tariff for day by day shrinking, right? They're very ambitious target put forward on tariff structure for renewable energy. So now there is a bifacial solar PV module available in the market.
Right.
So now whatever till today in Malaysia, we have got only monofacial solar module. But I've done some feasibility studies employing bifacial solar. Finally, it is not implemented, but we have done bifacial solar technology in some of the plants in Europe, which has really helped to improve the efficiency. Right?
Can I ask one question?
Yep.
Sorry, Vani, is it okay we make this conversational?
Maybe we can come back to this.
Okay.
Maybe we can come back to this.
Okay.
Yeah.
So the bifacial solar, of course, is having a very optimal efficiency.
That's right.
The main drawback is you need to have the ground treatment to improve the albedo impact. So it means the maintenance frequency of the ground will go up, right? On that perspective, yes, definitely the renewable energy can achieve the current competitive tariff, but subject to XYZ capex injection, right?
I think we can come back to technological advancement. I would just like to stop you there because we were covering risk just now, right? Yeah. Because I think on risk factors, I think both gentlemen has already spoke about, the kind of a project performance risk, be it construction, be it operational for various technologies. I want to now bring the question to Eric on the financing side of things, really. If you look at the financing side of things, right? What would you say are some of the key funding challenges, Eric, for the power projects today?
I think for thermal projects, not much of an issue. We already have a very established structure since the first gen IPPs. They have been financed by the bond market in Malaysia, right?
Yeah.
So and Vira also said underlying asset is very safe. Once it's operational, reliability is there, availability is there, right? So you have very stable cash flow for your thermal IPPs.
Right.
The challenge then is on the smaller renewable energy projects. And there are a few factors here. First is certainty of revenue. Because you only get paid if you generate electricity. You can't control the amount of sunshine, you can't control the water flow. So certainty of revenue is a concern. Right? How we try to address this as lenders is besides the debt based on P90 incidents. Whereas if you're a sponsor, you can take a more aggressive view, you calculate your returns on a P50 basis. Right? So that's revenue. The second, and I think it's one of the concerns by the participants today, is sponsors profile.
Sponsor, yes.
A lot of time, the newer renewable energy projects that we see in Malaysia are being developed or wanting to develop by new to sector sponsors, right? No experience.
Always a relatively new player.
So I think rightly so, investors will be concerned by this. My recommendation really is, which Halim earlier mentioned, you hire the right people, or you partner with an experienced developer. The developers that can bring your execution expertise, structuring expertise, technical expertise to the table, right? So you can execute a project properly, right? So sponsors profile, and then the new policy developments, CGPP, export of renewable energy. This brings about different sets of risks. You no longer have a PPA that is backed by TMB, right? The off-taker is different now, corporate PPAs. You sell to Singapore, you have currency risk. Maybe earning
nevertheless much stronger.
Singapore dollar may be better, but still currency risk is exposed. So no one size fits all solution. Every project has its own risk. We have to identify, address, and mitigate them for each project.
Thank you for that. If I may ask a bit more, can you share some lessons learned from some of the other experience in other markets? Are they very different from Malaysia?
Malaysia is unique in the sense that we are probably one of the few markets in the world that can do greenfield bond financing.
Right.
If you look at Indonesia, their project bonds are issued only after project is completed. Right. So they don't take completion risk.
Right.
So from a bond market perspective, I think Malaysia is in a good place. Where we are perhaps a little bit lacking compared to the region is from the bank financing perspective.
Bank financing.
Right. So our banks, we lend tenors of 12 to 15 years.
Right.
This is short, right? If you look at a construction period 3 years, then 21-year PPA, it's a 25
years.
That's
but
right.
you can only lend for half the time. Regionally, Thailand, Indonesia, Vietnam, Singapore, I think the banks easily lend 20 years.
Right.
So if anything, lessons learned not from a bond market perspective, more from a banking sector perspective.
I see. Okay, thank you very much for that. So I think now we can circle back to technology just to carry on earlier on. I think Vera was trying to explain to us what are the most current technological advancements, right, to be applied. Hydrogen was mentioned, ammonia was mentioned. I suppose what I'm curious to know is that with all these new technology coming on, does it mean more complexity and does it mean more risk? I guess ultimately that would be the key question that investors would be very interested to know.
For the rating agency as well.
as well.
Sure. Okay. So now, let's talk about hydrogen firing again, right?
Yes.
The current existing power plants, right? If we employ the hydrogen firing into the plant, so without doing the major adjustment to the plant, you can easily inject 30% hydrogen.
That's right.
Okay.
Whether it's a GE machine or Mitsubishi machine or Siemens machine, they are comfortable of firing 30% hydrogen into it.
Right.
So to burn the 30% hydrogen into the engine, so number one, the impact is operational risk.
Right.
It means your maintenance regime will be shortened.
Yes.
Right. So you may have to retune your long-term service agreement with the turbine suppliers. That's the key risk, right? Then when it comes to the guarantee and performance guarantee degradation, it has to be readjusted. So it means PPA will not allow you to do the interim amendments. So that's the risk.
Right.
Yeah.
Okay.
Well,
So
if you've also got long-term service agreement, you can't change that.
Yeah, you can change that out, but there are certain leniency available in long-term service
That's
agreement.
allowable.
Yeah, allowable. But if you shorten your maintenance cycle, yes, it's possible. You have to pay the additional fixed and variable fee. That's a possibility, right? So yes, definitely you can reduce the carbon footprint in the existing plants, subject to making XYZ operational risk, right? Of course, while doing this modification, the availability loss, how we are going to compensate the availability loss into the plant, that has to be properly looked at, right? Availability loss, your reliability, availability, retesting, performance, how it is going to reiterate the performance under PPA. These all factors needs to be predicted, right? Come back to the ammonia firing into the plants, right? Ammonia firing, they are not targeting into the gas turbine. They're targeting only into the boilers.
Okay.
Right. So while injecting to the boilers in ammonia, the efficiency wise, you will not have a major impact.
Okay.
So SCR, implementing SCR will have some impact on the costs and the capex, same availability, operation, and those risks needs to be mitigated. Otherwise, efficiency, I don't foresee a major change in that. Right. When it coming back to the bifacial solar, I talked about renewable energy.
Yes, that's right.
Renewable energy, monofacial versus bifacial. Monofacial is well matured. I think Eric talked about P50, P90.
Yes.
Now there is you can exactly predict the solar energy profile, right? The solar GIS data. Now they fine tune the data on 30 minutes basis. So you can predict the data as close to 30 minutes basis.
Wow.
You can tune your revenue profile on 30 minutes basis, right? There's a technology to do that.
So Eric may not do P90 anymore. He can do P50.
Yeah. It means what I'm saying is we can more closely match with the reality.
Okay.
Even the program can correct what is the today climate change based on the 1.5 degree up, rise. These all adjustments they can make. Right?
Vera, if I'm an investor, current technology, monofacial, 1 megawatt, 4 acres. What do we get for 1 megawatt in biofacial?
So
you can, acres?
depending on the energy treatment, ground treatment.
Okay.
You can have 20% more energy generation, 20 to 25%.
The acreage is still the same for your solar panel.
Correct. It means both reflections.
Both ways.
Both ways, right? So what is the risk in that? Technology risk. Of course, if Eric will say you demonstrate the technology risk.
That's right.
Right?
That's right.
Bifacial monitoring, there are very few technology available in the market. So we implemented a few plans in Europe. Is currently employing bifacial solar, right?
That's no rocket science.
Yeah,
Right?
yeah, correct. But it's a straightforward. As long as you are ground treated, you get the albedo, definitely energy will come out. There is no risk in that. So risk mitigation is possible.
Right.
The maturity will take some more time. So we are targeting
But
40% energy target, right?
That's right.
Definitely it will be possible.
70%, yes.
Yeah. Say for a tropical climate.
Yeah.
Because we got floods and all that. How high must the panels be?
No, that depends on your,
So again,
yeah.
so there's a science,
Yeah.
So,
right?
so one example, one of the power plants that was in Kedah,
That's right.
and it's flood prone area. So the technical advisor will obviously advise, right? Is this a flood prone area? You need to based
Bring
on
it higher.
50 years flood study.
Okay.
You need a certain
Okay,
amount.
I'll share with you other live example. So we implemented a plant in Koromarang, which is 100 megawatt
Right.
solar PV plant, right? So the flooding occurred in Malaysia to the implementation. So initially we started with the ground level, some certain elevation because of the flooding frequency.
Yeah.
I think there is some interim adjustment has been done to the level,
Mm.
right? There are possibilities.
Ways to do it.
Ways to do it.
So sounds like really the power sector is rapidly revolving.
Mm.
I suppose ultimately it is driven by growing demand for decarbonization and energy efficiency,
Yeah,
right?
yeah.
To that, maybe if I can turn to Halim.
No, can you touch on two more points?
Yes, sure,
Yeah.
sorry.
This, I think we talk about energy storage technologies to store and
battery
utilize the
batteries.
energy in the renewable form. Yes, of course, yes, that is possible. So certain PPAs request, say, minimum energy profile has to be, 13 hours, 14 hours, something like that. When you look at everyone knows that I think Singapore is heavily looking at importing the energy from other
That's right.
countries.
That's right.
So they set the renewable energy target 75% capacity factor. How to achieve that 75% capacity factor?
Right.
With solar PV, we cannot achieve.
Mm.
With the battery, you want to achieve, your battery cost will be more than your solar PV
Yes.
cost.
That's right.
Right? Unless you have the hydro,
Mm.
like, so Malaysia has the hydro potential, right? Hydro will act as a buffer to suppress your battery capacity.
Requirements.
So that's additional. So by way of mixing and energy, you can easily achieve the capacity factor.
Right.
That's another way of looking at it, right?
Okay.
Where you
Interesting.
can, There's another thing is everyone talks about CCUS,
Right.
carbon capture.
Carbon
utilization.
capture,
Yeah.
that's right.
So, but no technology available. Technology available, of course, is not matured in Southeast Asia, right? In Japan, they implemented certain CCUS in certain plants. Is currently working, right? So it's a lot of players talking about CCUS, but the technology is yet to get mature, right? So that's my view on overall.
Thank you very much. In fact, a lot of new information. I hope the audience would find it useful, about these technological advancements. So actually, I would like to connect that, to the next question, which is for Encik Halim. Really, when we hear about innovation in the power sector, what about innovation in the insurance industry? How can insurers work actually to help to, reduce some of the risk for power projects?
Thank you, Vanny. It also goes back to the digitalization. Pre-COVID, it was only a concept, digitalization and data analytics and predictive modeling. But today it is a business solution to do so. All this leveraging of advanced data analytics is being done. And the modeling techniques to enhance risk management, to also ensure pricing accuracy, as well as claims management too. So the industry is moving towards it. But what it needs to be part and parcel of the program right from the beginning, i.e. like the power plant producers are dependent on manufacturers to create innovation and all that. I think that's where the role we've got to play. The cross is to be able to understand the manufacturers, the sponsors and the producers' appetite against what's reasonably priced as an insurance collateral. Now, to get there, we need a lot of enhancement in terms of technology. So in innovation, one of the most common feature that we want to look at in innovation is to be able to engage developers in discussion right from the beginning.
Right.
Understand their risk profile, their project specific and risk mitigation measures. Because again, the insurance industry is no rocket science. There are already prescribed format in terms of coverages, but what's missing really is risk profile.
Right.
In a risk profile, the biggest problem we always look at is project execution or execution risk.
Right.
And if you push deliverables beyond the limits of what the plant can do, that's when the problem will start. And you get all these claims, like the business interruption claims, through machinery breakdown, through plant getting into all sorts of problems. So innovation is big in the insurer's mind, but the insurers will always play like second wave rather than the first wave. Instead of wanting to promote it, we'll have to depend on information. We have to depend on statistics to be able to conduct proper and accurate predictive modeling to be able to do so. But having said that, don't forget, insurers are also backed by corporate capital, which are businessmen. And this corporate capital wants to see the magical formula between risk as well as premium. So risk and premium is always analyzed from a very statistical standpoint. Bring ourselves back to focus. We need to understand the business. Therefore, insurers also, beyond everybody else, must have technically competent people, the Viras of the world, the Erics of the world, to be part and parcel of us as insurers, to be able to understand and see the profile and ensure that the delivery becomes more real. Right. That's the practice of innovation that we must see and must have.
Thank you for that. So I suppose then that brings me to the next question, since we're talking on topic of innovation, on financial innovation, I suppose. Eric, what are some of your key observations in financing power infrastructure? I'm just wondering about financing structures adapting to the general decline of returns for newer projects.
Yeah. So true, right, that returns have declined significantly, not just for thermal, but LSS. So for example, your Gen 1 NPPs, you're looking at 17-18%. Some say higher. Gen 4, it's for sure less than 10%. LSS, same. LSS 0, LSS 1, you have high returns. You see the LSS 4s, the tariff have been suppressed so significantly, so low that some cannot achieve financial growth,
let's be real, 17 cents is just not
17
doable.
cents. Right, so
very ambitious target.
Vicious.
So with these lower tariffs, obviously, it puts pressures on your cash flows, right? But from a financing perspective, because you have to fund this using the debt market, we will always try to structure it within the confines of the financing requirements. So rating requirements is very clear. You need a certain level of DSCR, you cannot exceed a certain level of DE, right? So from a debt perspective, I think there's not much room where we can innovate from the financing structure perspective. Where financing structure comes in usually is from sponsors trying to use financing structure to boost their returns.
Right, that's right.
Right. One way to do it is instead of 100% sukuk, they do a mixed loan and bond mix. Right? So this reduces your negative carry, reduces your project costs, thereby it boosts their return. Right? But again, depending on the market pricing at the time. Right?
Okay.
Another way is they try to delay the equity injection.
Right, delay equity.
One of the easiest way is you have a back-ended equity injection profile. Investors don't like it. The participants want to see sponsors' commitment.
That's right.
I think Benny also don't like it. They want to make sure sponsors are skin in the game.
Yes, that's
so in reality, not many sponsors can do this without recourse. Only the very strong ones, TMB, Petronas.
Right.
If I put on my financial advisor hat, I will argue TMB is a no-brainer. You have to accept it. Right? You are taking 21-year TMB payment risk. Why are you not able to take a 3-year TMB equity injection risk? Right. So I think it only makes sense for certain sponsors. We are also seeing them starting to, in lieu of the equity, to take junior mass debt as a form of equity. I think all these solutions, I think the key principle behind structuring this is we have to make sure that 80% that the sukuk holders, their rights are not compromised.
Not compromised. Ultimately protecting the lender's rights.
Ultimately,
and I think that's what investors would like to hear as well. So moving on, I suppose, to climate risk, I think something very close to our hearts right now, because we are already experiencing the effects. I'm sure everyone would have felt the more intense floods, droughts, and also heat waves recently, right? So given this, if I can ask this question for Vera here. Now, how are the increasing risks of climate change impacting execution and performance? I think you have touched a bit on that earlier. Maybe you could elaborate a bit more for the purpose of our audience.
Yeah, sure. Anyway, climate change is an intergovernmental complex challenge, which is faced by most of the countries. And of course, the impact is going to be ecological, environmental, and the social, political, right? So these are all the key risks, right, which needs to be done. Then, of course, because of this climate change, very difficult to predict the natural and environmental disaster that's currently happening, right? So in some of the projects, like, we did the thermal modeling and some of the, anticipated modeling using certain conditions, considering the climate risks that is changing day by day. For example, based on the, IFC regulations, right? When you mix the cooling water into the plant area, it has to achieve delta T 2 to 3 degrees, right? Because of this climate change, so day by day the temperature levels are going up. So even some of the bankers as well as the insurances, they're asking for the contingency plan. If climate risks comes up, what is the contingency plan? It means I need to size the equipments to cater for additional flow to suppress the temperature. That's the key risk.
Would you see more cost then?
Yeah, exactly. So it means if I want to size the traditional way, if I want to size the condenser for a plant, it costs X amount. If I want to comply with the stringent requirements, considering next to 50 years, my delta T is going to increase by 1 degree. So I need to put a contingency now itself. It means my equipment has to be sized to cater for
all these changes.
It means your capex is more.
That's right. I see.
Right? Yeah, ultimately it is going to increase your tariff, right? So that's the one risk, right? Then, of course, considering the natural disaster unpredictable, we need to have a contingency plan in the schedule. That's the key risk, right? Then it means when you do the LD analysis, the additional time delay has to be considered into your.
That's right.
In terms of financial model, the Eric will analyze in very detail, right?
Would you then say, right, we can no longer apply the conventional time frame that we used to assume for a time period to complete a certain project?
At least for next 3 to 5 years.
Right.
More or less.
All these
then another thing, another critical thing to highlight is, of course, everyone says gas to power projects are still ongoing with a little bit hydrogen mix. But while developing the gas to power projects, right, the gas price is highly volatile.
Yes,
right.
Because of this COVID and this climate and all those things. Now it's very difficult to predict the gas price.
Right.
So that's why the major projects are getting delayed only because of the natural disasters, additional schedule, climate change risk, and additional contingency on the equipment in the design. So these are all the critical risks currently they're facing, right?
Okay.
So as long as you mitigate with technological risks and the operational risks and putting additional contingency on the time schedule, I think still we can mitigate such risks and ensure the project will happen.
Okay.
Right?
Okay. Thank you.
So,
thanks for that.
That's my quick answer for your question. Yeah.
Okay. I suppose climate change would also impact the insurance side, right?
Yes.
So I suppose just very curious here, how is it impacting the industry, and more importantly, how is it impacting costs? I would say.
Yeah. I'll just take this very quickly because we'll probably be running out of time. Number one, there's increased frequency and severity of natural disasters all over the world leads to an increased insurance payout. Hence, when you get insurance payout, you perhaps will also have increase in insurance premium. Not necessarily directly inverse or proportionately, but over time it will show. Then this high loss also translate to tighter underwriting guidelines today.
Right.
Because it's not a question of choice in view of the uncertainties and the increased cost. Then again, it goes towards higher premiums and restrictive coverage. New policy conditions will also come, exclusions may also come, and all these may be introduced over time. But it's just not all bad news. There's some good news as well. Whilst the market will also further reduce in insurance capacity because all major insurers today, the providers, have to subscribe to the green technology. And these initiatives are also real for the betterment of the planet. But as I mentioned a bit earlier just now, don't forget, corporate capital behind insurers are also businessmen first.
Right.
So with innovation, with predictive modeling, with a lot of digital input and technological advancement, the insurers will gravitate into solving these problems over time. I believe, from my own point of view, Immediately in the interim, we'll see some increases, some tightening of the underwriting conditions. But over time, it'll possibly just equalize, just like water finding its own level.
Right, right.
But we need technical competence in the business. It cannot just be a businessman wanting to develop power without knowing what power projects are. That's the key to all this.
Okay, okay. I suppose then the other pressing question would be this, because we still have got coal plants out there supported, basically supporting our bond by the bonds and all that, right? Now, the question is there still appetite for insuring coal plants really?
Yes and no.
Yes and no. Okay.
Yes. Okay, let's take the geopolitical tension between Russia and Ukraine. Given that situation, we've got a lot of cutbacks in terms of fuel and fossil fuels coming from Russia and Ukraine. Given that situation, perhaps Germany is one of those now, which is starting to run their coal-fired plants again. So companies like Allianz of the world, the Munich Re's of the world, the Swiss Re's of the world, it's in their own backyard. So if it's a governmental requirement, they'll play ball. So it's only a question of time it comes back here.
Right.
I'm already starting to see there are markets to do this. But ladies and gentlemen, let's be real. Do we need just to be concentrating our capacities and collaterals from Europe? We've got China.
That's right.
We've got India. We've got Japan and Korea. We should look at our Asia Pacific market. China may have its difficulties, but along the way, China is a market for insurance to be considered to actually gravitate to, and India too. I believe there are solutions to all this.
Yep.
But look within ourselves. We're back to be the tiger economy.
I suppose it would be comforting to hear that it's not a hard no.
No, yeah.
So some comfort there for our audience as well. Now, turning to, I suppose, Eric, which is going to be on ESG, really. I think you have, Halim actually talked about ESG earlier on, about moral compass, integrity, and ultimately people and planet, right? And given that it's taking center stage, how has the ESG considerations influenced financing really for the power sector today?
Banks are very practical people. We announce ESG loan targets, we have to meet them, right? So if it's an ESG project or a project that has an ESG angle, I think banks will look at it. But similarly to the investors, I think they will still place significant importance on the underlying credit profile, right? But where banks are slightly different with the insurers, we really cannot do coal,
right?
So we can't lend to coal, and you see in Malaysia, they are not building coal plants anymore.
Yeah.
And I think for a lot of governments, they are doing the same, simply because there will be a lack of private sector financing for these coal-fired power plants.
Right.
On the other hand, then it's the emission from the environmental perspective. If let's say a coal plant wants to introduce technology to reduce emissions or carbon capture, carbon storage technology, if they want to do it, I think banks will consider funding this aspect of the coal project because it's beneficial from an environmental perspective.
Right, very targeted,
Yes.
What you're saying is
Yes.
okay.
Yes.
I think most of the banks, they stop funding for coal plants.
Yeah.
Yes.
Yes. Cannot really.
Insurers to some extent.
Yeah. But what about the existing plans? If someone wants to renovate the existing plan,
It will continue. The insurance collateral will still be there, but with some stringent conditions in maintenance as well as maintenance regime.
Okay, all right. Thank you for that. So I guess right now we have come to a point where we're ready to take questions from the chat box. So let's have a look. I think, the first question, it's about, I think the recent announcement this morning. How do you see the economic minister's announcement of significant new technology investment affecting Tenaga as an off-taker, which has its own partner plans, but need to follow government's broad agenda? I guess anyone can take this.
Eric will be best.
Okay. Would Eric want to have a view and share with yours?
Yes. Firstly, I think for the power sector especially, I think it's a matter of national security. So there will always be a broad master plan that is devised by the government. So Energy Commission will be the one that decides who, where to build and when to build the new plants. Right. Obviously, Energy Commission is part of the government. I think they will have to have discussions with the economic ministry and then see how they can tie up with these new technologies and make sure that the broader power master plan is met.
Okay. Thank you for that. And the second question is really on solar plants. I think just now we would have touched a bit. maybe Weera want to elaborate a bit more. I think the observation that the audience is saying is that solar plants seems to be deteriorating. Do you view this to be a result of a climate issue, irradiance, or performance of the technology used?
Yeah, actually, I think we can accurately evaluate the solar energy profile concerning the current softwares, right? So previously built plant, yes, we can see some of the plants have got the energy profile is deteriorating day by day because of course, because of climate change is one of the concern. But there are some adjustment made to the program itself while developing the new plant. We can inbuild this change into the program and analyze the solar energy profile to meet this adjustment. Right? Even the current program allows you to do the hourly profile also. Every hour, how you can generate the solar. Yes. So that I think that answers.
If I can add on a little bit more.
Yes, sure.
Most of these plants are designed to last the PPA, designed to last 21 years.
That's right.
At least.
Equipment, right?
Yes. So to just say climate and everything else cause the plant to deteriorate, that may not necessarily be true. What could be true is at the time of negotiation, everyone cut corners. That's when your plant deteriorate. So it goes back to risk management right from the beginning.
Fundamentals again.
Fundamentals.
Right.
Yes. Right. So I don't see that really as a problem. But having said that, there are engineering that can be done to current plants to upgrade it. And given the opportunity, maybe even bankers today are prepared to look at if you have got a proper engineering aspect to look at which guarantees you can control irradiance, but be able to feed into the capacity payment model better. Sorry, energy payment model better. I'm sure people would lend for you to engineer your plants to be of better condition. And time has come. We've got to do this perhaps every 5 years or 7 years, isn't it? We shouldn't take any more than that. Again, the moratorium in Malaysia is power plant owners have got a 5 years moratorium. What then do? They quit the scene. They enjoy the benefits. So if you start a project thinking of an exit plan, maybe that's a bit short-sighted for this business.
Right. Thank you for that. Okay, I think the next question is also on renewables. I think it's a general question for the panelists today. You know, the point that the RE industry is very competitive currently. Small and medium-sized companies competing for limited projects, and also because of this lack of scalability. Given the competitiveness and lack of scalability, there is a limited for existing RE players to scale up. I guess it's just a general thought on what do you think about the smaller size players in the RE space? Yeah. Anyone want to take this question?
Smaller.
I think if I may elaborate, if I get the question from the audience accurately, because we see in Malaysia quota release, right, for renewable plants. Unlike, you know, if we build a coal plant or a gas plant, we are talking about thousands of megawatts. Now, the smaller quotas, we're talking about 30 to 50 megawatts. So I guess the question is, what is your view because of the lack of scalability?
No, lack of scalability, renewable energy program, if it is large LSS program is launched, on this, they identify a site area, depending on, based on that, they give you the capacity for the development. As long as if they got a vision to identify a larger area for the project development, the scalability, I don't see a major issue in the scalability. Right.
Fact of the matter for solar is you need space.
Yeah, you need space.
Right?
Yeah,
space.
So if you don't have the land, I think it's very hard for you to scale up. You have the new technology, like bifacial or that's
yeah. But having
so
said
as long
that,
as space is there, we can.
Having said that, a lot of these power developers getting into the play has also got a concerted effort. They made the choice. So they want to go for 10 megawatts, or they want to go for 30 megawatts, or they want to go for 50 megawatts. In their own minds, in their own plan, in their own balance sheet promotion, they would have known over a period of this time, they would make a certain amount of money. So the question of scalability at that point doesn't arise.
Right.
But if you want to get serious into this, that's when perhaps you employ corporate capital from the lending capabilities of the bank and all that. That's when you got to get smart. You get the right people, then you go into perhaps acquiring other power plants, which are perhaps available in the system for you to re-engineer to provide better returns to yourself, and ultimately create it into like a property play where you can have a REIT of power plants, for example. Right. Now, the fact that we can export beyond our borders,
Yeah.
it gives impetus to current, perhaps power producers to band together, affiliate together, find the right corporate capital behind you.
Right.
And because I think solar is the best, we shouldn't be doing things like, or monkey business, like doing a gas powered plant and exporting cross border, because our gas powered plant is subsidized very heavily on gas fuel.
Rightfully so.
So we shouldn't be doing stuff like that.
Correct.
It's renewable energy that we can
Of
export.
course, one can look at the energy export utilizing the gas, but to some extent, right? So if you look at Singapore as a target of 75% capacity factor, that cannot be achieved only by solar PV plants. But they also set the target of CO2 emission. You can, as long as you bring the energy mix, which can achieve 130 kg per megawatt hour. That's the target. As long as you prove that whatever generation you are exporting, you meet that CO2 emission target, you can achieve that, right? So that's the leniency provided by the thing. You can have little bit mix of, see, we did some studies for export scenario. From Malaysia, if you mix hydro with solar, that's economical option.
Right.
Yeah.
In Indonesia, geothermal.
Sure.
Right. If you mix geothermal with the gas and solar, will make it. So in Vietnam, offshore wind with it's a technological option we need to study.
But in that scenario, you need someone who comes into the game with a macro management view of all this.
Yeah, instead of doing that, that's what I talked about. Asian grid integration.
Yes.
As long as
I agree.
all grids are integrated,
I agree.
we can claim that Asia has achieved green energy target of 2050.
So this is a very, very good point, because I think one of the questions now is also about this opening up of RE export. And I think this question here, which is currently highly voted, it's asking us about which are the companies that could potentially be prime beneficiaries, and whether the lifting of the ban will spur a bit more bond issuances. Maybe Eric could take this question. Yeah.
So I think for sure the existing power players will be the beneficiaries, TMBs, YTLs, especially those with renewable energy capacity. Right? Then they can start discussing on potential for export. We know our sponsors already looking at this even before the ban was lifted. Even for example, companies in Sarawak, the hydro that so these are the few players that will for sure
benefit from it.
Whether you hit the bond market, I think it depends on the scale,
right?
And also the risk profile. The corporate PPAs to the off-taker in Singapore, what's the credit profile? If these are adequately mitigated, I think no issue hitting the bond market with these kind of projects.
Okay, thank you for that.
But there are potential for energy export. Even players like TNB and Sarawak Energy Board.
Yes,
So
absolutely.
A huge potential for energy export. If they lift it up, I think there's a separate energy stream.
Yeah, but having said that, I think businesses also must look internally, because we've got to promote a multiplier effect within the country, not just producing here and exporting it, but producing here and making our energy sector more resilient as well as secure in the future. So that must also be the focus.
Okay. I think we probably have time for one last question before we round it up. And I think this is a very long question. So this one particular question is asking about data collection, I believe. This question is, shouldn't the new project start collect climate data on site as part of project design, given the data gap? Because existingly, there should be available data for up to 50, 100 years, but how come, projects are not, getting down to it? Maybe the panelists would want to address this question.
They're talking about design or
data collection,
collections of climate data.
Timely data collection for climate change problems, and maybe I can start it, because the view that the insurers have always taken is, whilst we've got the 100 years flood history, for example, if we look at flood 50 years history, we also look at what's going on potentially in the last 5-10 years. But with predictive modeling and all that, we would want to see.
Right.
So whilst we collect this data, which is good on-time, real-time data, but does it really change your commercial value proposition? It may not, because as far as the insurance industry is concerned, we still look at your past claims experience. And unless the data is very rich and real and at the same time accurate, for us to create a predictive modeling what will happen next 5-10 years with the current uncertainty of El Nino and El Nina, it is almost an impossibility.
Right.
So unless we are really like NASA and all that, where we predict based on political changes as well,
Right.
we are really grasping at straws because there's so much uncertainty in climate change.
Okay.
And
ultimately,
this is
still the
causing,
uncertainties,
The-
impacting the data
Yes,
accuracy and
yes,
collection.
yes.
Okay.
So hence, we will still go back to previous data. And with previous data, we project the forward data, which now has got a spanner in the works as well, because the forward data is also uncertain.
Right.
No, so some of the renewable energy plants, they are correcting the energy profile based on the climatic data. Day by day, they collect on the particular year. They compare with the data available from the database, and they do the correction. So it's happening.
It is already happening.
It's already happening in the.
But where the insurers wants to go forward and see this as well is technological advancement.
Right.
So if you collect this data in real form and in reality, and then prior to sponsoring the project or developing it, you have already included some of these enhancements, like Vera said. Then this normal collection can also be done by the time you hit your 5 years. You reverse engineer or you re-engineer, for example, to create. That's the only way.
But there needs to be a review, I suppose.
Yes,
a review, a
That's
periodic
a matter
review.
of practicality, right? It's timing. Right? If I develop a project now, I identify a site. I cannot wait 5 years before I start building a project.
Right.
It's a matter of practicality. I have timing pressure. I have competitors that want to do it. So the next best thing is to use data as close to the proximity as possible and use that as a basis of our analysis. So I think specific on-site data at the project development stage, I think very hard to implement.
Okay. I think with that, we have actually just reached the end of our allotted time. I would like to say a big thank you to our analysts for giving us their insights. I hope this session has been informative and thought-provoking for all. Stay tuned for session 2, and I would now hand over the screen to Hasli.
Welcome back, everyone. With us today, we have Mr. Vinder Kaur-Gill, RAM's co-head of Infrastructure and Utilities, to introduce her 3 panelists and to start with session 2. You are reminded to submit questions for session 2 anytime during this session through the Q&A box. Over to you, Davinder.
Thank you, Hasli, and welcome back, everyone, and a warm welcome to our panelists for spending the morning with us. So can I please invite the panelists to switch on your cameras and mute your mics? And let me introduce them one by one. We'll start off with Dr. Farhan from University Science Malaysia, Mr. Lee Chun Pai from IGM Corp, and finally, Mr. Leo P. Leong from CIMB Investment Bank. So it's fair to say that anything transport related sits close to our hearts as it impacts us daily and directly on our commute to work and back. While we are making strides in improving the infrastructure available, traffic jams and service disruptions at LRTs and MRTs have made commuting more of a challenge, particularly in Klang Valley. Against that backdrop, we have invited these experts to weigh in on the issues at hand and to share their ideas as to how we can create new opportunities from the challenges that we're up against. So before we start, let's hear from the audience who dialed in today, who consists of diverse stakeholders from various infrastructure sectors. Hasli, if you could please pull up the poll question for us. Okay, the outcome of the poll serves as a good barometer of the audience's sentiment, and we're hoping that it aligns with some of the viewpoints that are being raised by our panelists during this webinar. So it does appear that the highest concerns range around performance and operating risk, as well as project economics and viability. So now let's get this conversation flowing. As per the earlier session, we will have a 4-way banter for around 45 minutes, followed by the panel answering the Q&As from the audience. So please keep your questions coming. We will start with Dr. Farhan. So as a starting point and to set the stage, let me cite a recently published study by the University of California, Berkeley on urban mobility and where Malaysia stands on the world stage. UC Berkeley assessed 60 countries in their urban mobility readiness assessment for 2023, and Kuala Lumpur ranked 40 out of the 60 countries surveyed. We ranked quite lowly for sustainability, but a decent 23rd for our public transport efficiency. So, Dr. Farhan, against those findings, what would your top two to three concerns on the areas that we are falling short in? And what are the healthy conditions for a vibrant transport sector that are missing today?
Thank you, Davinder. First of all, thank you for having me as part of this exciting webinar. To answer your question, I mean, the result is not surprising. I think my take on this problem is the top 2 or 3 concerns of the country, which corresponds to perhaps the survey results, is our cities and countries' ability to balance between accessibility to travel, between private modes and public transport. I think this is to allow seamless travel regardless of whether one has ownership of any vehicle or not. So I think that is very important for mobility in relation to sustainable transport and sustainable development goals in general. That's number one. I think number two, my biggest concern is the issue of governance of mobility. We have quite a fragmented governance among several ministries that may actually have conflicting goals between mobility needs and whether we can collectively as a country move towards sustainability. So I think that's another concern. And when SPAD was closed, I think we have lost an opportunity to elevate public transport in the country and commercial vehicle in the country to a standard or to a world standard where it will facilitate productivity of the country and the wellness of the people. So with this problem, we still have many fundamental issues, especially in the understanding of the demand behavior of our people. And that will also implicate on the subject matter of this webinar, the financial models, because financial models will have to depend on the travel behavior for viability of projects. So without accurate understanding of demand behavior, I think that is a cause of concern. So my take, this would be the 3 biggest concern as a transportation professional. Thanks, Davinder.
Okay, so to recap, it's largely cohesiveness in terms of how we plan forward for private as well as public transport.
Mm-hmm.
Okay, we'll move on. So the policy and regulatory landscape for highway sector has been under scrutiny for years. And there is the sense of uncertainty from flip-flops and a lack of cohesiveness, like you mentioned earlier, Doctor, in the transport agenda. So Chun Fai, as an early investor in several highways, what is IGM's wish list from a regulatory and policy perspective? And could you please share any views that you may have on how we can instill a sense of calm for the highway sector?
I can also quit from here, right?
Yeah, you can quit. No problem. Just leave the webinar.
Thank you, Davinder. A very good morning. Thank you for having me at this webinar. Indeed, there have been a lot of noise on the regulatory front on the whole industry. I guess government has to be clear on the role, or rather the strategic role of toll highways, which is privately funded, against the position of the government that what is the role of this highway to be continued as an industry, to be privately funded, and compare that with the development expenditure that the government has to expand the network of roads. Obviously, I think today it is very clear that there is a role for privately funded highway. And the role of this highway is also complementary to the public transportation investment by the government. So as long as government is clear about the role of the highway, I think the industry will be there to support the government's aspirations. And I guess when it is a decision taken that there is a role for privately funded toll highways, and therefore rules has to be clear. Investors want a level playing field. I guess when government make decisions on the existing highways, for example, if I pick one example, is when government decided to reduce the toll on the North-South Expressway, right? It causes issues to investors, their shareholder, and it causes an issue to their funders as well. And it causes an issue to roads which is running parallel to North-South Expressway as well. That decisions which is taken without clear thoughts on the implication and the game plan to resolve any implication causes uncertainty and causes unnecessary tension to the stakeholders of the industry. So obviously the wish list is, if rules are clear, well thought out plans, it can work very well for the industry. Thank you.
Point noted. I think there is the sense that there is a certain amount of fragmentation going on as to which highways come on board and which don't. So some sense of clarity or leveling the playing field in that sense should help private sector engagement. So P. Leong, we'll move on to you. CIMB was involved in the restructuring and refinancing of the Plus highways and Amanat last year. I guess the Plus refinancing is kind of like leaning towards the example Chun Fai cited just now about the reduction on toll rate. So in your experience in resolving all the issues that highways face, what is the best, what's the role that may be best left to the public lawmakers and regulators? There's also a related question to this, particularly when it comes to amendments of existing concession agreements and cash flows. How can we preserve the connective tissue between stakeholders, especially the lenders, when these restructurings are done? There were instances of highways supplemental concessions being inked without consultation of lenders, and that was seen to be upsetting to some. P. Leong, over to you.
Yeah, thanks, Davinda. I'll answer both questions together. I think policymakers should consider the impact of revisions to the commercial terms in concession agreements on the bankability of the project. And there should be due consultation with all stakeholders of the project, not just the shareholders. So frequently negotiations on concession agreements are driven by shareholders and the regulators only. I would suggest for feedback from lenders and external parties, such as the rating agency, to be sought before any revisions are finalized.
Any other experiences that you can share as to where the government's role should be amplified and some of the other, responsibilities left to other stakeholders?
Yeah, I mean, as policymakers, they definitely will take into consideration the impact to the people, the road users. That will be first and foremost, I would assume. They will also have, to abide by their internal policies and regulations. But again, I would suggest that, all these matters should be viewed in a holistic form, and rather than just looking at, certain quarters, being benefit from the restructuring exercise or any amendments to the concession agreement. Again, the views and the considerations should be given to all stakeholders, not just shareholders, road users, but also other stakeholders, as I mentioned earlier, lenders, and rating agencies, because it cannot be a situation where we only take a very very limited, a very myopic view, and only benefiting certain classes and certain stakeholders to the detriment of others.
Okay. We'll next move on to Dr. Farhan, and we'll cover a little bit more into project bankability and economics. So, Doctor, from a project viability standpoint, be it a highway or LRT, MRT project, the key determinants to sound project economics are equitable risk allocation. And this usually relates to construction risks, maintenance upkeep, and traffic demand forecasting, as well as modeling. So we as a nation do not necessarily have a stellar track record on all three fronts. So could you please shed some light as to why our PPP projects have been predisposed to issues such as inflated costs or, allegations of inefficient spending, overestimated demand, and in some instances, even over-design?
Okay, thank you. I think leading from the governance issues that I've cited earlier, I think what is most important is the demand estimation and understanding where we are and what do we need to do to facilitate mobility and productivity of the country. I think that's how we started. So back then, we had a good planning of our highway network through what we call the Highway Network Development Plan, where we actually foresee intercity linkage, inner city networks, and therefore plan it accordingly to influence demand as well as to cater for demand. But of course, Malaysia had a history of being car-centric in the past. So we had a very good and comprehensive highway network development plan, which of course, along the way through privatization, I think we have sort of mixed between the plan and the need to invest and perhaps make money through the investment. So, but if it is within control, I think there's no issue. However, if we were to be more sustainable and if we would like to balance it with public transport network, we yet to have the rail network development plan. Okay, so any of our rail networks at the moment are sort of an afterthought or a new project, which requires convincing in terms of its project viability, which also requires a demand estimation to show that it is a viable project. So this is where we have a problem, because in Malaysia, we have not been doing a regular independent demand estimation analysis. Okay, many of our demand parameters are related to projects. So we can question its independence, its accuracy, because without this periodical demand estimation and modeling, the trend is something that we will not be able to track. And these are all important elements when we do demand behavior modeling. So this opens to rooms for inaccuracy. So which is to your point of overestimation or underestimation, which is being used by investors to look at project viability. So I think, it was an opportunity for us to use PPP to advance, to have the projects. But I think we can improve if any of the project proponents' demand estimation is triangulated with a more independent periodical demand modeling and demand behavior studies, which from my end as a transport professional, we have been looking at who to sponsor and how do we do this, because other countries, for example, UK or even Greater London, they have every 10-year Greater London Transportation Survey, which is very important because it tracks the vulnerability and the changes and the volatility of demand behavior, especially now when we are going through such unprecedented change. VUCA, for example, COVID, we still do not understand post-COVID travel behavior change. So how can we actually then do an estimate of demand to support any viability of a project accurately? So to me, that opens to a lot of errors. And I think we have to go back to basics. If our country is to strive in terms of its sustainable transport agenda and aspirations for the future, which is very important. We know that we are suffering now. Even our highways are clogged up. So how do we quickly find that balance? And because we are relying on investors, we are relying on true viability of project. I think we need to start our baseline correct. We can use all the previous data as baselines and make corrections with the most recent behavioral change. So I think that's very key. And if we can do that, I am confident that our future investment, our future financial model will be more, will give us the returns, and all the concerns that was shown in the poll earlier, hopefully can be answered. But one question: who's going to take charge? So that is also part of my biggest concern. MOF take charge? Now Ministry of Transport, or we're talking about Ministry of Works. So who's going to take charge? So that is also a big problem that we have to face. Okay, yes. I'll stop there first. Thank you.
I think agreed is that if the starting point is the traffic demand forecasting, and that tends to be on the high side, then the entire value chain of the project economics gets disrupted along the way. So essentially, once the asset is up and running, then it can't justify or uphold the initial project economics. Dr. Farhan, I'll just have a follow-up question on maintenance culture.
Oh, yeah.
So
I missed that. Okay. We have a unique situation at the moment where, as far as rail is concerned, I think at the moment the highways are quite complete because of the general bill operate transfer model. But the rail at the moment, especially the MRT projects and the newer LRT project, we have two proponents, right? The developer proponent, so we have MRT Corp, and then we have the operation component, which is Prasarana. I am not clear, maybe some of you will know better the contractual agreements between the two. But Prasarana will be taking up the operational side, which from the transport economics, we know that demand elasticity for public transport is not that big. And therefore, Prasarana has to make sure that they have enough revenue from all means, not only from passenger, of course, but they have to do the maintenance. And maintenance is also subject to the original construction and design. So there is a passing of baton between two important proponents for the project. It has worked to give us the infrastructure, but as we all know, Prasarana is having a lot of challenges. So I think it is a venue where we need to deep dive and understand through data and through being creative on how we can make this model work, especially if there are similar models from the rest of the world. Because maintenance will be affected if our operator do not have the correct cash flow, and maintenance will ensure level of service that is expected by users, and public transport users in a very private centric community is very vulnerable because they can just change back and for Malaysia, it's not only cars, we have motorcycles as another competitor in terms of model split. So I think this all adds up to the complexity of the issues, which is very interesting because it is an enabler, but at the same time, it could also be giving us a negative implication in terms of maintenance and long-term operability to ensure seamless travel on public transport. That's my view on maintenance. Thanks, Linda.
Okay, Chen Fai, moving back to you. IGM has a mixed bag of success and challenges in your highway portfolio. So before we go into funding or rating considerations, the sponsor itself must be comfortable that the risks involved and assessment at the sponsor level are manageable. So please give us a brief overview of how is project selection undertaken at IGM as to which highway projects IGM is open to be involved in, or you may shy away from.
Thank you, Govinda. I guess broadly, if you look at the toll highways, there are two broad categories of highway. One highway, which most people are aware, a highway that is needed to solve traffic congestion, or a traffic is needed to service a future high-density development in certain area. So those are very much needs-driven type of highway as a possible solution to move people around. Secondly, it's a highway which is interurban, so it connects cities. It may not have traffic congestion issues to resolve, but it opens up new development, it opens up new industrial corridor, and just like some highways, it connects the ports as well to the commercial industrial area. So when you look at it, the traffic projection for these two categories of road, it's very differing, the characteristic, right? A demand-driven kind of a highway where you know the congestion, you know this is as an alternative to a highway or to an existing road. It's something that is easier to predict. But however, the difficulty would be that at a certain toll rate, what's the acceptance of the user? So that again poses a challenge in coming up with a determination. What would be a revenue model for this type of investment, right? Whereas those which is interurban, it gets a lot more challenging because you will start with a low base, but growth rates would probably be stronger, but it stretches over a period of time as developments take place. So hence, you are dependent on economic activities, you are dependent on development along the corridor, and you have to take that into account. And then if you were to look at your costs of investment, the capex of the highway, obviously in the city, it will cost you a lot more. In the city, chances is you would probably have more elevated section. Some section you may need to tunnel it, and that escalates the cost. And given that the city folks would probably be able to afford a higher rate, so chances is there will be acceptance as everyone would not mind to pay for the comfort that I can get another half an hour of sleep and I can get to my workplace faster or I get home faster, right? Cost structure always an issue in the city roads because in the city to cost out an investment for a toll road in the city, there are a lot of services that run beneath the road and that always poses a lot of challenge to us. And obviously, if you look at land costs today, cost is also increasing. Value of land have increased quite significantly. And therefore, land cost is something to be considered. So in the balance of all these parameters, one have to pull it all together, run your financial model in the best estimate that you have. What makes sense and what doesn't make sense. And for us, we have exposure in both types of roads. And as I started, sometimes it may not be your doing, your parameters are fine, but there's a curveball. Your competing roads suddenly became cheaper. Then it causes a problem to your financial model. And that's something that we have to take it up with the regulators. You have to look at how to deal with the future because if the toll rate becomes wider, the differences, it become a challenge. And when we look at road, I think there's always one parameter that overarching that one needs to consider. In this era of ESG, I guess if one would to look at investment into a highway that cuts across a forest reserve, I think we may probably avoid that type of road. If a highway that cuts through a high density area, it may cause discomfort to property owners. But I guess to invest in a highway, whether you invest or you don't, I guess it's no longer just the bottom line. I guess everyone wants to be responsible. Hence, it is not an easy decision for a promoter to make a decision whether or not to invest in a highway. Yeah.
Okay, there's no silver bullet, essentially. Okay, I think I'll stay with you, Chun Fai, for the next question. You briefly already went there, that costs to build highways and by extension, maintenance costs may vary quite widely for the individual highways in Malaysia. Land acquisition, again, another sore issue that continues to result in ballooning costs and delays. So in your opinion, is there any room for standardization and more transparency on this front? So I think beyond the sponsor, would it be helpful to encourage independent or third-party involvement when it comes to selection and deciding, which highways should be built and what is a reasonable maintenance expense?
I guess there are two types of proposals here. I think if it's something which is driven for the government, it's in the network master plan and the government does an RFP, the parameters will be clearer. There will be another basket of projects, which is private sector initiated. And that would be something which in line with some of the parameters that the government wants in the network of roads in their master plan. But there's some interesting proposition from the private sector that it can make the highway possible and government would give consideration to those highways. So when you go into the cost structure of projects and to standardize it, then there's no fixed cost per kilometer to work on. I know most people will go on a rule of thumb, cost per kilometer, how much. The reality is cost is not easy to estimate, but one have to make a best estimate in the proposal. And bearing in mind, a proposal may take 2 years, a proposal may also take 3 years or 4 years. Hence the challenge to determine what is a reasonable cost in the future for the highway is a challenge. You know the cost of it today, but you're building it in a few years' time because it depends on the decision-making process by the government. So being able to standardize, I think that would be a challenge. However, government today, I think it is a lot more vigorous process that we go through. If I look at my personal involvement in the industry 20 years ago, decision-making was a lot faster because the need for infrastructure in the country, right? Today, decision-making would be lengthier, and that's because the process to a decision by the government, you go through various processes. I think since you touched on the cost structure, for example, the government does a very detailed scrutiny on the proposals from the private sector. Government also hired third-party independent consultants to review the proposals and the costs proposed by the private sector. Hence, the transparency, it's no longer as simple as cost per kilometer. I need a highway, get it done quickly. I think everyone wants to make sure that the cost is a fair cost, it's a reasonable cost, and it is something that won't cause a project to be in a situation where the financiers funded it, but it was insufficient to complete the highway. Hence, there must be a balance because of the risk that a promoter takes in determining a cost for the future and also in determining what is underneath the land where there are services and the soil condition to be taken into consideration as well. Yeah, thank you.
Chun Fai, just to share insights, right? With this cost overruns or ballooning remaining as a risk throughout the construction period of 5 years or less, slightly less. Any insight? How, as a sponsor, has IGM managed all these challenged or poorly performing projects so that you still continue to give it a lease of life?
Yeah, I guess in the course of this COVID, upon the recovery of COVID, which caused a problem because of a delay, so 2 years plus stop, and when economy opened up, resuming, there were lack of workers, resources were limited. Then you have the Ukraine-Russia war, and it causes an escalation of building materials, and it's rare. It happens, right? And that's a business decision that one has taken. And you reach a point that you never expected COVID, you never expected a Ukraine war, and you hit with a situation of cost overrun. Obviously, that's where the stakeholders got to be together in this. I guess, be it the government, be it the financiers, and be it the promoters. I guess they have to strike a balance on the way forward, right? Everyone will say, I want you to take up the cost, right? Government will say, not my problem, you take care of it. Probably the financiers also say, I don't care, you take care of it, that's all I'm going to pay you. And the promoter will be the one saying, if only money is unlimited, I wish I can take it out, right? Hence, in most instances, I must say, every stakeholder is very logical. Every stakeholder is very sensible. At the end of the day, if a project gets abandoned, everyone loses. The promoter loses, the government, which promised the rakyat a road, don't have the road for the rakyat, and the financiers, money has been disbursed, but there's no income because the road is not completed. Hence, there's no fixed formula. I guess in our experience, we bring everyone to the table, and at the end of the day, to craft up a plan, everyone chip in a bit. Everyone, yes, it's uncomfortable, but we need to get this done, and the situation is real. Hence, as long as all the stakeholders, the objective, we have a common objective, right? And in most time, I find that people are sensible about it.
Okay, that's comforting to hear. So when compared to other neighboring countries, Malaysia had a head start and strong investor appetite for financing greenfield transport projects. P. Leong, please share your views on the initial secret sauce or building blocks that worked, and why is it that there is an increased sense of wariness or caution from the debt capital market investors today, especially when it comes to greenfield highways?
Thanks, Davinder. I'll start off by saying that we are fortunate to have a deep and liquid debt capital market in Malaysia, where we have many funds who are able to take greenfield or construction risk, as well as very long-term fixed rate exposure. Right? So you don't see this, in the region, or in fact, in many, many countries, or even in the global markets, most investors do not take greenfield or construction risk. So we are very fortunate in that sense. And I think this is a combination of a transparent framework involving rating agencies like yourselves, independent external advisors, who provide the comfort to the investors over and above their internal credit process. And in addition, we have a conducive and supportive regulatory framework, which accords protection to investors, plus the strong structuring skills of Ranger banks. All these provide additional confidence to the market. Unfortunately, in light of recent credit events in the infrastructure, some investors are taking a more cautious approach in terms of investing in long-term projects, particularly greenfield projects. The triggers for these events vary, but I personally think there are already sufficient checks and balances in place in the current bond origination system, and the existing regulatory framework, is sufficient. But the reality is there is no perfect system, especially if there are parties determined to game the regulations and controls. So as an arranger bank, we structure, we provide protection, ring fencing. Of course, in discussions with rating agencies like ourselves, we try to provide comfort to investors. But when it comes to situations where it's a fraudulent act, for example, or there are malicious attempts, or there's just plain disregard for covenants and conditions, in the bond or sukuk structures, those are very hard to mitigate. So in those sort of situations, then it's up to the bondholders then to take legal action, if there are any breaches. So we've seen some of these situations happening. We hope this will not be a norm going forward.
Okay, just to expand on that, in terms of the policy and regulatory environment, what's the sense that you're getting from the investors as to how that continues to play out?
Well, I think typically after certain credit events, those affected investors will then, call for more protection, whether tightening of the regulatory framework or more intervention from the regulators like the Securities Commission. But I don't think that is the solution. Tightening and making it more difficult for issuers, to access the capital markets. I don't think that is the panacea. It has to be a balance, to make the capital market vibrant and accessible to issuers. But I think as what the Chung Fa alluded to, all the parties have to stand up and be counted, meaning they have to play their role. Issuers, arrangers, investors, regulators, everyone has a role to play, to make the capital market work. So I'm not a proponent of just tightening and making it stricter in terms of the regulations and regulatory framework.
Okay, let's move back now. Dr. Farhan, this will be over to you. So with green mobility as a policy priority, let's move to discuss shifting mindsets around public transport. So Dr. Farhan, in your view, is there a generational leap we are making with the younger commuters' willingness to live without a car? Also, this may be a sensitive topic, especially for the highway promoters, but would you be in favor of advocating restrictions of road usage in the coming years? I think this could take various forms, including congestion charging, removal of subsidies, higher car purchases taxes akin to Singapore, or even just advocating pedestrian and bus lanes.
Okay, thank you. I think at the end, what do we want for the country? So if we want for a more sustainable transport, I guess we need to have that balance. All right, even though we have been investing on road projects for many years and has helped the country definitely, but as we know, we cannot survive on just roads. We need to allow mobility to happen. I remember mobility is also not only for people but also for goods, which is also another issue that we have not discussed here. But coming back to your question, this generational difference is actually something that is positive, because as you said, the younger generations, because they grow up in an environment where public transport in Kuala Lumpur and Klang Valley has been established, so it becomes second nature to them. And being young, they are more energetic and they are open to try all the different available modes. So I think this is something that we need to enhance, so that they do not think about vehicle ownership immediately, because they know that they can go from one point to another on public transport. And of course, with e-hailing and Grab, that has also helped. So I think that should that is a plus point that we should capitalize. But again, we need to understand also their behavior. Do they change when they become wealthier, they become more senior, or this will continue as any of the other established countries in public transport, where we see, any people, regardless of their standing economically, they will use public transport. So we need to understand that, and where at least we do not have enough data to show that behavior and how it will change, because this is important for us to use in our demand estimation. So that is a plus point. But in terms of restraining measures, I think, you know, any effort to have this balance requires some restraining method. We are investing heavily on public transport infrastructure now, i.e. rail in Klang Valley. And of course, we want it to be well utilized. So in order for that to happen, two things must happen. Either we induce new demand that goes directly to public transport, like the youngsters just now, or we need some transfer of mode from private users, right? So in order to do so, it is not easy. Okay, it's not easy because private vehicle, as we all know, give us the comfort, security, reliability, and we are in control in a way. Okay, of course, subject to congestion. But nowadays, you know, congestion sometimes becomes also useful because we need the break, and of course you have your gadgets to entertain you. But at the end of the day, as far as sustainable transport for the city, for the country, we need that balance, and therefore restraining measures have to come in. And for everybody's information, we actually, to give credit to the formulation of the Public Transport Act, the Pengangkutan Awam Darat Act. We have a chapter on traffic restraining measures in there, and I was privileged to be part of the team that formulated it. The idea was, when we have prepared the infrastructure and the operation of public transport like we have now, then we need to balance it with restraining measures so that we can actually encourage or force people to move, right? So before we couldn't do what Singapore has done for many years because our public transport network is not there or was not there. So now it is there. So it is already a license to do so. Okay, so but again, of course, the question is whether the authority is prepared to do so. And to me, we should not allow freedom totally for private users to the point that it is inconveniencing, you know, giving us inconvenience now, especially in cities. So parking, for example, we can start to make it more regulated, you know, make it more tough, so that people feel the higher generalized cost. I know this is not, as you said, this is not popular, but again, what do we want for the cities? Okay, and we must remember, the only city that has a very extensive network for public transport is Kuala Lumpur and Klang Valley. We do not have for other cities which are also facing a lot of transportation problem. So I guess the government has to decide what they want. Even though openly, of course, they want sustainable transport, they have all kinds of policies that support it. But on the ground, I think we still have a lot of things to do, from fundamentals, from establishing demand behavior, to experimenting on some form of restraining measures, because we do not want to start it when it is too late, when we cannot get out. And we have seen many cities, especially metropolitan in the developing countries, that are already beyond help. I think our cities in the country is still within help, or within finding its solutions to the problem. So those are my take of the issue, Devinda.
Okay, time frame wise, given that there are still challenges in the first and last mile when it comes to public transport, is it something that you have in your radar 5 years, 10 years from now, or is it something that you think can be implemented quite soon?
This is something that we should have done. Okay, it should be part and parcel of the planning of public transport. The first and last mile is very critical for people to use public transport, and I think we are learning, we are picking up. But again, it is still car-based last mile and first mile services. You know, we are increasing the parking, which is good, but I think we should also look into more effective feeder service, and I think that is not easy. I know it's challenging for Prasarana now. The feeder services are not that, so not that positive, because it is a culture change, So, but at least walking access in terms of accessibility to all the stations and bus stop must be properly done. It is something that needs to be done, and here is where again another player needs to come in, which is the local authority. So I think this is another challenge for transportation. The fragmentation of decision. We have to work in the synergy between all authorities must be there. And I think a lot through my own experience, we cannot get a common goal between the relevant authorities. So first mile, last mile is more of local authority with the public transport operator, and then you have the roads versus public transport issues and fundamentals like project evaluation and viability, which is part of demand estimation. So a lot of challenges, and I think all of you as investors are actually relying on this. And I think this is something that needs to be done urgently. Thank you.
Okay, Chin Fai, I think it's a common practice or premise that privatization models are about privatizing profits and nationalizing losses. Any insights as to how we can bring collective action between the private and government sectors so that we have more efficient, broader, holistic transport or travel infrastructure?
Thank you, Levita. I really wish what you say is true, then I wouldn't have toll roads that's losing money, right? So the fact is that privatization, there's risk and reward. Obviously, outcome may differ from what you expect at the onset of a project. Hence, the balance of risk, it's something that promoters take with the government and the financiers in spearheading or moving a project forward. Obviously, toll roads today, in yesteryears, I think you look for, you say in Kuala Lumpur or in PJ, you look for new township, Puchong is opening up, let's do a highway. Then Putra Heights is open up, let's do a highway. You do it because there are developments that take place, right? Today, I think when we do highways, we say, let's link to highways because we have enough network of highways, right? So you would want to link as many highways as possible. Therefore, options available to users become wider and you're casting a wider net. Lately, in the past few years, another dimension that comes in that when we look at network of highways, we look at public transportation stations. Where are the LRT stations? Where are the MRT stations? You would like to have your highway to have some link that connects to some of these stations as well. Hence, it closes the entire loop of the role of a highway. You want to move people. Highway, like it or not, is still one of the cheaper options to move people around. It costs a lot more than MRT or an LRT. And some highways, if you look at it, it moves 200, 300,000 cars a day, which is a lot more than some of the network of the public transportation that we have. Hence, this goes back to the point that I started off. It is complementary role for highways together with the public transportation that we are not a city like Singapore where it's dense and it's centralized. Our cities are, the most common house is still link houses. We are a very flat city, hence to connect as we develop, it will be wider and wider, and that's where the role of the highway, because not everything can be resolved with public transportation, but the combination expand the function of the public transportation, whereby you bring more people. That's why park and ride kind of concept works very well. Hence, balancing return, balancing the needs of the nation, and balancing the final objective of all this is eventually to move people. Yeah.
Okay, so there is a role for each one of your. I think we are kind of like short on time, so let's just go into the Q&A. We are in our last 15 minutes so that we try and keep time. The first question is a highway that I guess we all can guess what it is. I think we have taken a stand that because none of us are directly involved in it, we'll leave it to the government in terms of justifying the project selection and the need for the infra. We understand that there is a fair bit of community that is upset and affected by this law. But Chun Fai, I think briefly, you did mention in your project selection, you do look into whether it has quite a disruptive feel to it in terms of who will be affected. Any views you want to add? Or
Well, I guess when it doesn't affect you, it's very easy to express an opinion that on the bigger picture, the connectivity of a highway or a public transportation project is needed. The reality, I think maybe the question, the person who posed the question would probably be one of those that is affected and felt that I have quiet enjoyment of my property today. This project will affect the quiet enjoyment of my property in the future. And secondly, my property is probably worth a certain figure today. And in future, I see destruction of value in my property. Hence, the uprising of those affected that this affect my future. I guess that there's no straight answer to this. If you look at MRT, when the government did MRT, there were protests from pockets of residents in certain neighborhoods. A first world public transportation project, great for the country, great for the city to move the people, but there will be pockets of people who will be affected. Hence, government have to look at it in a bigger, broader perspective. Yes, these pockets is there, but the infrastructure is needed, hence we need to continue with the project. But I think what is important is how to deal with the affected or aggrieved parties during construction, post-construction. Is there any way to compensate them for their losses? And are there any methods to reduce the impact of the infrastructure to the community? Those are the things that the government has to have that conversation with the affected parties, and at the end of the day, to find a way forward in those circumstances, I guess.
Now, I guess
can I pitch in a bit on that point? I think I started off this session by highlighting the alignment or the right of way that is part of pre-planning that we should do. So I think a lot of this problem, either we do not conform to the original highway network development plan due to new needs and new opportunities. Okay, that's why we have this kind of situations. And what concerns me is the future. You know, we still do not have a real network development plan. So if we want to strike the right balance as proposed by all of us here, either it is the highway network development plan or the rail network development plan, that will assure us that we will reduce the probability of such conflicts. Because the alignment, the new alignment of new projects come after we have actually agreed on land use development. And in terms of physical planning, that should be coordinated. So to me, the the root cause is actually when we do not conform to the actual planning. So I think we still have many other cities in the country to be able to save from such problems. So that's just my response to the issue. Thank you.
Yeah, I think what we have noted or learned from this conversation is also a lot of the LRTs and MRTs, the onus of funding falls on the government. So in terms of the cost to serve or the OPEX, CAPEX recovery model, right, I think it's still quite opaque because a lot of the private sectors have been a lot of it is government guaranteed. So I think that probably needs a bigger conversation, a longer conversation, really, in terms of the cost to serve. Ultimately, how much is the built-in cost, all considered? So we have two very popular questions here. The first one is, I think I'll go to Pilion. From a legal and structuring perspective, are there any ways to protect bondholders' interests against government's unilateral actions to amend highway concessions, such as what happened to Bisraya and Aneh recently?
Yeah, I mean, from a structuring perspective, typically the bond structures or the bond documents will be entered into and will be binding on the issuer, or in this case, the concessionaire or the concession company, and the trustee acting on behalf of the bondholders. So, although the government typically is not a party to the financing documents, the concession company will be a party to those documents. So, for the government to amend the highway concessions, I don't think they can do it unilaterally, because the concession agreement is also a bilateral agreement. So the concession agreement has the concession company has to agree to any amendments that the government wishes to amend or to revise in the concession agreement. So the Sukuk document, as I mentioned earlier, is not the government is not a party to the Sukuk document or the bond document. Indirectly, the concession company, should take into consideration the Sukuk holders, views, or the bondholders' views, and in the event that any changes to the concession agreement has a negative adverse impact on the bondholders, then they should mediate and ensure that the government is aware of these concerns. And if there's a bank that is advising the concession company, likewise, the bank should highlight the concerns. It could be also concerns from the rating agency. So all these, again, back to my point earlier, all the views, from all stakeholders should be taken into consideration.
Okay, moving on to the next one. Under the current policy and regulatory environment, would it be possible to revive a currently abandoned highway that is over 80% completed? Who could be the potential white knights to inject additional funding? I take it, Chun Fai, this may be to IGM.
Well, in our life, I think we have rescued two projects. I think a lot of people didn't know MPE was one of those abandoned projects, and Lekas is also another abandoned project. The reality is it is possible, but I guess, like I say, the original promoters, the financiers, and the government all have to play their role on the way forward. And that's always the challenge, to get the thoughts to be aligned, to get everyone to chip in to make the revival of the project possible. It's not a straight answer, but from what we have gone through, we find that you need all the stakeholders to be together. And when everyone have a common objective to revive, that's where I guess most will be sensible. But many a time you find something may not be able to proceed further. That's because there are some who take a very firm view, who insist on certain requirements, and that would cause a problem towards a revival of it. You just got to get them on the table, set a timeline, and it's a yes or it's a no, and move on with life.
Okay.
Yeah.
I think there's one directed to you, Chun Fai. As a highway operator, what's your view on the multi-lane free flow toll collection system?
MLFF. By the way, government have changed. It's no longer free flow because it gives a wrong connotation. It's multi-lane fast flow now, as is known, right? And I guess there are some issues regarding the implementation of MLFF. You do realize without the pole that is the barricade that is stopping you from going ahead, and when you remove that to be fast flow or free flow, some can actually get free flow because you don't need an RFID sticker and you can just pass by the highway. Hence, the regulatory framework need to be clear how to deal with those circumstances where someone just passed by without an RFID sticker. That is something that the government have to consider on the enforcement, how to do that, which agency does it, or is it passed back to the operator, your problem, you take care of it, or government say, I will deal with the regulation. All these guys who just pass by without RFID sticker, we will go after them, we will fine them big, and so on. So things need to be clarified. Secondly, I guess technology is there. I think MLFF, RFID is not a very new technology, so I believe you can overcome technological difficulties. Another challenge that we'll probably have is to the existing concessions. You have invested on a toll collection system, and now there's a new system that is required, hence how you deal with the cost that has been incurred and how you deal with the future costs. Obviously, we would expect whoever that wants to do that, they have to fork out the capex. And finally, it will be the business model. Whoever that operates a MLFF, whichever company, what would be the cost to the concessions on this MLFF? So unless the business model is clear, the cost to the company is clear, I guess that's something that the players would have to take into consideration on how to move the MLFF proposal by the government forward. So there are still a few hurdles to pass through on this. Yeah, thank you.
Yeah, I think it's interesting. This cost and revenue loss have been discussed for years, but we still, I guess, haven't landed on a solution. All right. I think there's another question on sustainability. Basically suggesting that, private highway developers have touted how the highways are sustainable and green. However, I guess you cause congestion and emission. Additionally, you also consume high amount of commodities such as concrete and steel. So given all these factors, how can the bond market justify funding such clearly environmentally damaging and sustainable highways or unsustainable highways? Yeah, I guess anyone willing to take this up? That any infra
maybe I can take it up. Yeah, I think this is what the country wants. We talk about mobility and getting people move, but at what expense? So I think we need to take toll. The world is asking for us to take care of the future, right? So I think we know that transportation is the biggest contributor to a lot of negative things in terms of sustainability. So I think we should take, under the spirit of ESG, I think this should also be looked at. But again, data, we don't have enough data. We sometimes concession role and highway authority role, LLM's role, LLM should look into this, because concession has its own proprietary information. But in terms of the interest of the people and the country, I think there must be a thorough and a regular assessment of how things are going, doing construction, doing operation, and how, in terms of carbon count, in terms of emission, and so on. We need to do that if we are truly very serious about it. Just about the multi-lane free flow, or I think one of the things that we need to address is actually, you cannot compartmentalize this, okay? We see highways even cannot get the variable message sign, universal information. We do see that some of the VMS are very proprietary based or concession based information. So I think unless we correct that, I think the issues that was highlighted earlier will also haunt the multi-lane, because it's it's something that is cross concession. And if we don't solve this silo mentality in terms of public goods and public facility like this, we always have that problem. Just a short response to the earlier question. Thanks, Evinda.
Okay, I think we have come to the end of the webinar. We probably don't have time for any more questions. In closing, I'd like to thank everyone, and I hope both the sessions today have served to provide valuable insights, and there's something for everyone, all stakeholders. So as a credit rating agency, we hope to give a clearer picture of sometimes the lens that lenders may be looking through, especially when they talk about bankability and funding. So I think we just wanted to share this perspective with all stakeholders. So we hope to see you again and wish everyone a very good day.